button.
Should I go get my banner?
Yeah, you
Okay.
should. You should have a big banner behind you with,
Yeah.
exactly what, Trillion does.
It's too late. It's too late now, but you can get it. Yeah, go get it. Yeah, but it's too late. The start button has clicked. So
we can see Jeremy's banner. We can't see Meredith or Mike's banner.
You see my kitchen.
Yeah.
Kitchen?
that is Lone Depot green, Mike.
I'll relocate in a little bit and maybe use the backyard.
All right. So if you dialed in, we are actually also having some fun. Even so, the subject of money mortgages is usually a pretty serious one, and I think I have to adjust my screen a little bit. I think and this is our Monday Zoom call where I update people on what's going on in the real estate market and also what's going on. The banner comes out.
Look at that.
And look at that. And what is going on today in the money markets. And a lot of stuff has been coming at us with this crisis. So I don't know. We're in the fifth week.
Move your head to the left, Bruce.
Okay.
No, the left.
We are in the fifth week of this whole quarantine, and still I don't change my opinion. I have been working from home for a while, and I just really miss my gym. Okay.
Fifth week is the seventh week.
What is it?
It's the seventh week.
Actually, by
March 15th.
Yeah. Yes. So, but it looks like we have flattened the curve, and now the question is, what do we do now? How has our business changed? How has it influenced us as investors, or as probably we usually have a couple of newbies on the call, and how has it influenced even our life, right? So I'm trying to get you guys to rethink real estate, because not just real estate, I think every business is rethinking their strategies and their business plan, how they move forward in the next few weeks, months, and then maybe what is happening next year. So I think everybody knows kind of my name is Lenska Realty. I'm an investor. I started investing and then became a real estate agent and a broker. So, and for over 10 years, I have educating investors through some field trips. And if you have kids in the background, or your dog or your cat, just mute yourself and then come back. Okay. So that's kind of to my background, and I'm trying to really tell people what's going on right now in the market, because it's super important that we actually really keep a weekly eye on what is happening, because Mike, here we will move forward and see who we have today on the call. So we have Leo on the call, who is a developer, home builder, and educator, but he also raises a lot of private money, and I'd like to hear from him later how private money lenders maybe already have changed things. Then we have Meredith and Mike from Loan Depot, and I'm sure they could fill this hour and a half by themselves to tell us about the updates. And then we have Bruce May from Trillion Capital, who is a hard money lender in San Diego, and I think Los Angeles. He will introduce himself later yesterday. And then I want to just give you guys another alternative and creative way, and nobody's too much talking about reversed mortgages, and we have Jeremy Knock, the golden age financing. So you have another tool in your toolbox to solve possibly money problems. So, and here it is, because Mark Twain said, to a man with a hammer, everything looks like a nail, right? So if we're so limited in how we perceive our tools we have, and we're not educating ourselves, then we're very limited on what we can fix. So I launched a poll. So I think today I can tell by people who are on the call that we have a very experienced group, so which is kind of great. So we can maybe change up the format a little bit and kick it a little bit around what's going on in the market. So we got a few newbies, and we have mainly very experienced people. Okay, good. Just down my line so I can skip quickly through those slides. So usually real estate market update, recap of some headlines, and then we have the experts speak. I think Bruce, may I have you after my market update a little bit, because I will reverse. So right now, I'm trying to really separate the facts from the fiction and the frenzy. It's very hard because we have different agenda group or groups that have agendas putting out the news. So it's really hard right now to get through the noise and figure out what's going on. So we all know, and nobody has forgotten the last crisis, right? And we knew that in the last crisis, we practically saved Wall Street. And so this time we also, will we bail out some bad actors once again to forestall the clearing process? And when I say the clearing process is really the reset, and that we maybe see some real estate drop, or, you know, how will we reprice the world, and how we will be rebalancing the kind of haves and have-nots, right? So we can also organically kind of grow and are not building a house of cards, okay? Then today was the news where that big businesses got the small business money, but little guys were left empty-handed. So today they restocked the money, or replenished the money in the SBA loan, because that Harvard is getting millions of dollars where they have cash on hand, I think is not quite fair. And then today, some Colorado counties allow in-person showing starting this week. So obviously it has been a different scenario right now. Listing houses, showing houses, marketing houses, and then we were closing the deal, okay? So, and most realtors are still playing it safe, because it's literally a question of who wants to be liable if somebody, you know, gets the coronavirus. And then we got the meat rally today. So today, I think everybody talked about how the supply chains are interrupted, and that we could see some food shortage, okay? So guess when people can't go to the beach, they go on the streets and fight for their rights. And, you know, I appreciate it a lot. I felt like this was totally unnecessary, but I assume big government grab for the power is more important than the people's health, even so they pretend telling us they really worried about. So question for you, what is this a photo of?
Boats in the water.
Yeah, but what have those boats?
Gold.
Oil.
Yeah, okay. So this is what's, and you guys have heard how the barrel of oil, a photo's worth millions of barrels of oil, okay? So we need to take that into our kind of equation. Then just some good news for the coronavirus. This is just what came right from the National Health Institute in Italy. So practically what you see here, that a lot of
I can go to the other room. What'd I say?
Coronavirus's death have actually underlying illnesses. And yesterday I saw a post on Facebook practically translated. I fell today. I had to run away because somebody didn't keep the social distancing of 6 feet. And I ran, tripped, and I broke my ankle. And at the treatment, they marked it down coronavirus related.
Wow. So you got a cast?
I'm just joking, but yeah. So no cast, but this is practically what that Facebook said, that a lot of stuff is just marked as corona related because that's how the hospitals get reimbursed right now from the federal government. So as you guys can see, it's very hard to come up with the right numbers. Yeah. And same thing, some people say real estate prices are up, down, everybody has a different opinion. So, but we know that to keep in mind what's important for the outcome of this whole thing, a little bit long-term, that the Fed practically keeps the printing presses rolling. It's unlimited QE, trillions in relief funds. I mean, the whole world is, but the United States can print money. That's the advantage. And it is the world currency, okay? So the federal government, Federal Reserve started now also buying mortgages or mortgage-backed securities, I should say, and hope Mike will all explain this better to you guys, and municipal bonds and corporate bonds. And that's what I said about the bad actors. There were corporations that had very bad balance sheets, bought back their shares to enrich themselves, and they really mismanaged their companies. And are we supposed to bail them out again?
We always do.
We will.
Always do.
Yeah, we will. And some of it is obviously, and we need to because there are jobs connected with it, right? But so what are we looking at? So this is the world situation. So now we're dialing down to San Diego County, right? So is it a good time to buy and sell? So March
Maybe.
statistics don't have a lot of changes. We're still going up in medium home price. We still, our inventory is down. Our days on market, everything closed pretty quickly. Pending sales are down, okay? But we had that last year too because we still don't have any inventory. But the sold listings were only down 1.4%. And price per square foot is holding strong at $430. So, but that was 3 weeks ago. And I know you guys don't want to have any old data. So, and here it is. So we have seen a decline in sales number, but we have not seen a price decline in San Diego County. Yes. Now, wait a minute. Okay, so that was for March. So then people were telling us, okay, the luxury market, anything over, 2 million or $1 million is, so then I thought, okay, what is closing? And I did take out one sold that of guy, Bill Gates, bought that $43 million house in Lamar. So I took that out of the equation because that screwed up all my numbers, okay? So, but this number here, 499, okay. So this is obviously down 45% because there's simply not a lot of listings under 500,000.
Right.
Right? So 500,000 to that is pretty steady, right? But actually, look, we're still doing pretty good on the $1 million plus properties.
So is that 378 closed sales? Is that what I'm seeing?
Yes, yes.
Wow.
So, but the market is moving so quickly and things have changed, and I hope Mike will explain to us what is happening in the jumbo market because San Diego is very expensive. So then I see new listings by price range, right? So where do we see any, we don't see any increase in listings anywhere right now. We do have a slightly up, so this is all March data, okay? So don't confuse it. So March, because we're closing on the houses that we're getting into contract from February or even January. So March, so we really have to look at the next months, right? Because this is where we see the changes. So these were the solds week by week.
Hold it.
From March to April, first week, second April, and third. So, and what I'm looking for is, will the sales price, first of all, will the list price close, like this is the list, LP is list price, I probably should change that, list price, so people know it, okay? I'm going here. And then we have list price per square foot and we have sales price. So March 21st, last week in March, we had a sales price of 603, and this is the median. Then we had a 625. We had 626, was holding steady. And so last week we closed at about 638.
Hey, Lenska,
Yeah.
how many units is that per week? Do you know?
We had about per week we have, I think, about 400, because I think we have 1,200 altogether. Yeah.
So basically last week we had 400 sales.
Yeah.
And
Yeah.
we stayed pretty close to the list price on the closing price. That's good.
Yeah. Yeah. So because, I mean, we have about 1,000, but we had, you know, usually we have 3,000 a month. Yeah. So,
Okay.
but, so I'm looking week by week now, because to see if that median home price actually is changing. Yeah. So right now I don't, you know, I don't see too much going, you know, but on the other hand, it might go up because we don't have any cheap houses, okay? So this might make it a little bit more clear where the market is heading. So this is also week.
Okay, thank you so much. She's always dropping it.
Okay, we have the solds, so we have new listings, we have pendings, and we have solds and off market. So the blue one is the first 2 weeks in April. The orange one is the first 2 weeks in March of this year.
She's dropped that. It's a miracle we still have it.
All
Thank you so
right.
much. I really appreciate that. She
So,
loves doggies.
okay, I have to mute everybody because we have somebody that's playing something, playing a game. So the souls, obviously you guys can see we still, yeah, oh, here it is, to your Leos, to your question is the souls are down to about, you know, just over 1,000, where last year we were about 1,600. So that's why I said we have a 30% drop. So the pendings obviously went down as well. And we're down, pendings were just over like 620 units, where last year for the first 2 weeks we were about 1,700. And so, yeah. So I try to unmute you guys. So if you have questions, but so
Yeah,
you
that's very, when you look at that number right there in the middle, the pending, as well as the sold off of 2019, there's a big disparity in what's coming on the market and how fast it's moving compared to last year.
yeah, but you also see that these pendings will be closings in May.
maybe or maybe not. I mean,
Yeah.
there's a lot of fallouts right now. There's a
Yeah,
massive amount of fallout.
and I hope, but then look at this one. So in new listings, actually new listings are a little bit up.
Yes.
Okay, so which means who wants to list their house right now? These must be motivated sellers, and we could see, could see a price drop. Right. So now we get to the money part, because I always say, so I looked at, so what are we doing? How are we financing? Our investors, obviously, our investors are still buying, and how are they buying? Okay. And as you guys can see, the blue one is the cash, the orange one is the conventional financing, and the gray one is FHA, VA, and then some, others that it's just the leftover. So we can see that the cash sales have declined. They went from about 200 units to 134. So we had, in the first 2 weeks of April, we had only 134 cash closings. And I know that Bruce May has probably provided loans to half of those and is doing very well as a hard money lender. Okay, I can't see you guys, but yeah. All right, but we do see, obviously, a decline in conventional, and we do see an increase in FHA and VA. So that's what we're seeing right now. But to the cash sales, that's practically, so I think I want to do my second poll, which will be, share results from that one. And then I need to do my second poll, which is, stop sharing results. And then my second poll is real estate prices. Do you think real estate prices will go up, go down less than 20%, go down more than 20%?
We don't see it. We don't see it.
Oh, here we go.
There we go.
Okay, so since we have all these pros on the phone here today, okay, so last time we had I think we had two people that, 2 or 3 people said whether go up and stay the same. So it looks like nobody thinks that prices will go down more than okay. All right, so if you guys can't make up your mind, sorry, or maybe you're not, so I'm sharing. You guys see it? So I think we kind of agree that the go down less than 20%. Okay. And that will be probably next week's subject, because right now we don't see the prices going down, but we will look at some of my favorite number. But before we do this, Bruce May, are you on?
I am. Can you hear me?
Yeah. So we just saw that much less cash transaction closings than they used to. We also have less inventory. So what do you see as a hard money lender? Introduce yourself, see what you're seeing in the market, and tell us how you're changing your business, or has it already changed?
Sure. Hi, everybody. Bruce May. I'm hard money lender with Trillion Capital, and my area or territory is San Diego County. We also do loans Orange County, LA County, and up in the Bay Area, part of Riverside and part of San Bernardino as well. Things have been changing, yes. So let me address what you asked, Lenska. We as a company had stopped lending for about 4, maybe 5 weeks. And last week we started looking at loans again on a case-by-case basis and trying to evaluate smart projects. So things where, or projects where investors were getting into slimmer deals, say 2 months ago, would be something that we wouldn't want to look at right now. We want to be on the conservative side. And I'm hearing the same from other hard money lenders as well, that they're doing the same thing. So
We were talking about this the other day.
yeah.
So are you're not at that 70-75% ARV anymore then?
No, it's probably less. I would think probably right now maximum loan is 60 to 65% of the after repaired value of a project.
Well, you're better than most.
Yeah.
Most are at 50-55.
Yeah, to be honest with you, Leo, and you know, I won't pull any punches. We're not funding many loans. We've put a few offers out for some projects, but we haven't had them come forward and accept the terms that we've given them. So I don't know if if those people, I haven't followed up yet to see if they're not moving forward or what the status is. But yeah, we're funding less money toward the purchase. So we used to fund 80 to 85% of the purchase price. Now we're looking at, you know, maybe 60 or 70%. I don't know if we'll go even above 70% right now. And then on the renovation budget, we typically fund 100%. We're still looking at doing 100% of the renovation.
Yeah, but when that happens, when you cut back the percentage on the ARV, that investor has to come up with more out of pocket. So
that's right.
How are you gauging that?
Well, it's based upon a conversation with the borrower. If they're bringing their own money to the table, if they've got a partner who's a financial partner, or if they're bringing in a junior lender behind our loan. So we're looking at all those things to try to evaluate the project. I'm seeing more gap lenders, which are the junior lenders, that are saying no to deals and are wanting the investor to bring some of their own money in, or even a greater amount of their own money into the project. So,
okay, we had, just let me interject here. We had a couple of newbies. So just that when you talk about gap funding, so the hard money lender is usually, and that's what we're talking about, providing the financing for 75, maybe 55% of the purchase or the after repaired value. But then still, if you don't come up with the difference, you will need to find a second lender, okay, that goes into second position and comes up with that, what we call the gap funding, or in order to close it. Now, yes. Bruce, have you increased your budget as in on construction cost, or are you're still lending on the rehab cost, right?
We still lend on the rehab cost. We'll do 100%. We've seen actual construction costs for materials have come down, and you know, the cost for lumber has decreased, the cost for copper has decreased a little. So we haven't really had a requirement there that we, you know, have a higher budget amount for rehab projects.
Are you, when you underwrite the deal, are you now start looking at who the contractor is on the job? Because if they file, let's assume they can pay their bills and they file bankruptcy or something, you know, then the whole job comes to a halt.
Yeah, we always look to see who the general contractor is, or the experience level of the borrower, and the number of projects that they may have done. You know, a first time fix and flip person is probably going to be scrutinized much more heavily by us or any other hard money lender right now.
Absolutely.
Because it's so easy to have a small item turn into a big item and completely ruin a project.
Yep.
Based upon the market. And the other thing too is long-term projects right now are probably not something that most lenders are going to want to get into. because Leo, you can attest to this, right? How longer you hold a project, the more chance that you could have something come up that completely turns your project around. So, you know, the quick fix and flip projects are preferred. You know, doing an addition or adding the accessory dwelling unit. I could give you a couple examples right now where I've got projects that are literally stalled because cities are not moving quickly on issuing permits.
Yep.
They're just sitting and they're taking their sweet time.
Well, there's skeleton crews, and you have to submit digitally, so it slows the whole process down.
Yeah, or Leo, if they are taking paper, they put it in quarantine for a week before they even touch the plans.
Yeah, you cannot, in most cities, you cannot submit paper in most cities.
Yeah. So, you know, 2 months, 3 months, maybe even 4 months to get a permit for a simple, you know, 1-bedroom addition for a, you know, like a master bedroom suite. That just adds all that much more time to a project and starts eating up profit.
Yeah, and we're about to do something I've never done ever on a project. The La Mesa project, the building permits have to be paid by credit card or debit card.
Wow.
You cannot pay by check. In a certain city.
Now, you know, thank God you can't catch the coronavirus at Walmart, at Target, at the sporting goods, and at the drugstore. Because if you could catch the virus there, we would be really screwed. So
yeah, I mean, the city of La Mesa doesn't want anything coming across their desks, so they have made it where just to go and get your building permits, you got to have a debit card or credit card.
Yeah.
Yeah. So I think
Venmo.
we're all in that same boat to adjust to these to the new normal. So so it will affect the investors' bottom line because now they have to rethink their cost and their offer amount, and also obviously then their profit. So unfortunately there will be, you know, there will be the casualties and the collateral damage, whoever was in the middle of a project and had permits pending. So
well, here's a question, Bruce. Have you guys taken any projects back lately?
Well, we have, but not because of the coronavirus. It was prior to that. So we took back two projects in San Diego, sold both of them to a new investor, not a new investor, but to one of our investors who does lots of projects. He resold one of them and is working on the other. So yeah, we did. But right now, because of this virus, we haven't had to foreclose or even move into that situation yet.
Well, the next one you do take back, call me.
I was gonna say call you. Yeah. Well, Leo, you're familiar with the couple that we looked at. That,
I know.
That we did. So, but since those, we haven't had to do any, which is a good thing. But we're also one of the more flexible hard money lenders in that we want to work with a borrower as much as possible to get them to succeed and not take that project into a foreclosure. It's not in our interest.
You're going to come across all these investors buying it too high of a price.
Exactly. Yeah.
So, but I can gauge that the less cash sales and you are underwriting less deals, which I appreciate because you want to help the investors and rather say no and they have to look at their numbers instead of moving forward and then something happens. So
yes.
So everybody has your information right here. I think big on the screen, and if you want to put your you're there, and you also have been an investor. So if people want to have a second opinion, so give Trillion or give Bruce May a call. And I appreciate the candor. So hopefully you're going to hang around a little bit. Bruce,
yeah, I'll be here. Yeah, I'm
later.
going to listen to what everybody else is talking about. And if I can throw one more thing out there, Lenska, do you remember back in, when we had the 2008 crash, I was flipping houses at that time, and when we were buying, we were trying to project out how far into the future it would be for a sale, and we were deducting 1 to 1.5% per month on falling prices. So we knew that our after repaired value would be less in 4 months or 6 months than it was today. And
Yes.
I don't think we're there just yet, but I wouldn't be surprised if we end up there in 6 months to 6 to 9 months.
Yes, and I think everybody says the same thing. We're all waiting until we reopen the economy to see what the demand is going to be. But even that, I will move forward with my slides, is going to be such a moving target. So this just shows you the daily activity on the MLS. It's usually 3 times that. So definitely activity is down by a lot, okay? So in here, what you should be looking at, the 6 best indicators to watch. So back in the day, railroad traffic has been widely followed, and actually Charles Dow, I didn't even know that, invented the average Dow for the transportation age, which forecasted kind of the stock prices, okay? So then we all know that you can check out the U-Haul and moving truck rental fares to forecast the next best appreciating market, okay? Nowadays, we actually also look at Zillow and Redfin online searches, which have been increasing in the last 2 weeks to look more at suburban areas, okay? And then obviously we always use, and this one is a used vehicle value index to the right that is watched as an economic indicator forecast, because as you guys can see, when this drops off, the recession is starting. So the used vehicle sales are pretty much right on. And then in real estate, we always look, is the inventory increasing? Yes, it is slightly increasing. Do we see a lot of foreclosure rates right now? No, not yet, but I put a slash in there because we're stuck in this forbearance twilight zone, okay? And Mike will elaborate on that one. And then obviously we look at interest rates, but interest rates has been going nothing but down. So there are a lot of bad news out there, and especially when it comes to the commercial/retail real estate. If you guys all know, in Carlsbad, there's this little shopping center, has a Coyote bar in there with fireplace. It is the most hopping place you can imagine. So if you look through the windows, they already have taken out the chairs and the tables and everything else, okay? No, but I wanted to also, obviously, that these all that's all has to do with job losses and where the economy is going, yeah? But that is too commercial. When we are not in commercial real estate, yeah? We are in the multifamily sector. So, and a lot of people do feel like multifamily is on one of the better tracks right now, okay? But we will see, because on the last call we did last Monday, we said that only 70% of the people paid their rent, right? So we will see, but multifamily right up behind industrial will have the fastest recovery, okay? So now unemployment, because how can we buy a house if we don't have a job or a part-time job, or maybe no real estate commissions anymore, okay? So 10 million filed for unemployment in 2 weeks, but last week the initial claims were down. Oh wow, they were down from 6 million to 5.2 million. So right now we have an unemployment of 18% unemployment rate. 10 million lost their job during the entire recession of 7 and 8. We had only a 12% unemployment rate. And it was 25 during the Great Depression. I'm telling you guys, tomorrow you can apply for unemployment if you are in the gig economy. or like real estate professionals, like mortgage brokers, that work on their, I think those are 1099 jobs, real estate agents and brokers, they're also, so they all can file. So tomorrow, which is actually good. So finally we'll capture those numbers and know the exact numbers. So some people do say we will see a high. Now, right now, whoever lost their jobs right now in the first beginning, like restaurants and all the services, are those people necessarily home buyers or homeowners? So it is pretty clear that a lot of homeowners have a little bit more cushion, but not that much. Okay, here we got 26 million jobs lost so far. There's a huge difference on if you can able to work from home or not and keep your business and keep things going, okay?
Wow.
Yeah. So and I want to get to this one here. The unemployment as high as 20 is a real, wow. That was from last week. I had that in there, okay? So
Wow.
we're close to that. But it will affect not just the less than 50K jobs, it will affect many other areas. And and we have, and you see how quickly those numbers change. So just from a week ago, we're moving up. Unemployment rate in San Diego, we're still doing pretty good because remember we have the military and we have technology and we have biotech. We do have tourism, and yes, people have converted their vacation rentals into long-term rentals.
So is our unemployment 4.1 or 18%?
Yeah. Yeah, I mean, that's what San Diego was last, that was in March.
Okay.
Right? We don't know what it is in April yet. Okay.
Lenska, there's
18%.
Say again?
You got a screen showing 18%.
On my screen?
Yeah, one of your screens was showing unemployment at 18%.
Yeah, that is US wide.
Okay.
Yeah, that was a US, yeah. So, but I'm always looking at San Diego because San Diego is always, we got to look at our market,
Yeah.
I mean, as we always say in real estate, it's really location, location, location. And there will be different winners and losers depending on what industry we're having. Each city will have. Today,
So this is accurate. Our unemployment for San Diego County is 4.1%.
in March,
Wow.
so
That's not that bad, really.
yeah, no, it's not. And that's, you see, I mean, we still had sales. We still had that median home price was pretty consistent. Okay. But California was actually the first one that did the shutdown.
Yeah.
And so we had double-digit declines of home sales. CAR predicts more declines in April. 20% sales are jumbo loans. Okay, interim time between, and Mike, hopefully you can, there's a huge, right now, a disconnect of what the government wants the mortgage industry to do and what is actually possible, okay?
So when you say CAR predicts more declines in April, and then your one screen showed the last week in April being very active, how accurate is that?
And CAR is California-wide.
Right.
Yeah, so that they predict more declines in home sale. And we see, remember, the pending, we're already much lower.
Right.
So, and these convert into closed sales. So here you guys have it, suburban home searches increased. So people, and by the way, Switzerland reopened the economy. And guess where most people went shopping?
The malls.
No.
Amazon.
No. To the
ski resorts.
To the garden center. Okay, so think food shortage. All right. We have
Lenska, I had a quick question for you.
Yeah.
I don't know if you saw this, but I just got this morning. It was an email. And according to Black Knight, there are 3.4 million loans that are in forbearance, up by 500,000 from a week ago. I don't know if you're going to speak on that later, but I'm sure Mike's got a lot of inside info on that as well. But exactly. Those are massive numbers.
They totally underestimated it. Now, will we have people that want a free ride and people also remember the IQ, the homeowner IQ is not sometimes very high, and they don't read the fine print, okay? Because if you have to pay it back, that forbearance, I think I have some slides on that forbearance. I just want to get through these ones here. And then obviously I can't wait to hit up my contact up in Sacramento to see if they will convert some properties to affordable housing, like, you know, some of the retail centers or even some of the malls, right? It would be perfect. So that all will put pressure on, but then again, we need banks to lend. So here are some things we gotta be aware of right now, that borrowers, they just holding off because they believe both interest rates and prices of homes are going to decrease in the months to come, okay? Then lenders that actually are able to close and fund new business and offer competitive pricing. So I always say, for you doing fix and flips, and then you gotta have an experienced lender on your hand, and that is up to date and has several different programs. So that's why I invited Mike to speak. And then, you know, some real estate agents are still pushing for these 30 days. It ain't happening, okay? So just count on delays. Appraisal will be delayed anyways, and Mike hopefully has some input for us. Their borrowers are willing to come. Are they coming to closings? Or if La Mesa doesn't even accept a check, you know, sellers willing to, do they come to the closing? Trying to not catch the COVID-19 virus with all of this. Then do we trust the new technology, the mobile notary, right? Some people still have an issue with signing on DocuSigns. And then lenders have different overlays. So I think Wells Fargo was caught, that was not supposed to get out, that they stopped lending on jumbo loans, okay? And they had to paddle to put some PR in it, that they now still do or not, but banks are getting very careful. And then nobody knows anything. There's a lot of uncertainty and unknowns, and it's just super unpredictable right now. So, and we know that this is what's going on right now. There's a lot of, or was at least, demand for the refis, and the mortgage applications did go down. So now we come to this whole forbearance. What is it? Faux pas, and it's a forbearance. What's the right word for it? Snafu. I think there's a word out there. I'm learning all these new words while I'm doing all this here, which is kind of good. And it's very tricky to balance those, because first of all, is it a GSE? Remember how after that crisis, we wanted to get rid of the GSE, of the government-sponsored mortgage banks. So how would that have played out right now if we would not have the Fed back those mortgages now and help? Hopefully they will find a program to help those servicers, which is a whole different, oh, here it is, forbearance FUMBLE. That's what I was looking for, okay? Because first of all, some people didn't get the relief checks. And I mean those $1,200, those unemployment checks or whatever it is, because they were late. Payments were due, right? So homeowners will do anything possible, obviously, to file for unemployment and to file for forbearance, okay? Then they had so many phone calls, the lines were clogged, and people were getting up at 3 a.m. in order to log on and see if, you know, they could get through. Plus, all the websites are so outdated. Some are, I don't know if you guys know the computer language COBOL, but nobody can program in it. So it's not easy to change those and make those forms and everything. And then, by the way, you know how President Trump likes to have his signatures on everything, right? And here's a fun fact that he wanted to have his signature on those checks that were going out, but he is not an authorized signer.
Oh.
I didn't know that. The president can sign the checks from the Treasury Department. So
Nope.
now they agreed that is going to go in the memo line. So there were another week went by, okay? So, who's just said that? Black Knight? Here it is. Nearly 1.4 million borrowers with mortgages backed by a government-sponsored enterprise or GSE are in forbearance. Black Knight said in a report on Friday, that's about 5. I think I actually heard that this is already up 7% of the outstanding loans.
So I've got it right here in front of me, Lenska. It's now 3.4 million. It's a total of 6.2% of all mortgages. But what that translates out to is it's 5.6 of all GSE and it's 8.9% of all FHA and VA loans.
Okay, so 3. What
FHA and VA are higher?
Yeah.
Wow.
Okay, so you can see, it's just, you know, to make all the, and that is what, nearly 7%, you said?
Yeah.
Okay. Wow.
Yeah.
And you know, we haven't even started on it. So
April was the first month that people actually had a problem making a payment. And so if they're getting their stimulus checks delayed, I think wait 4 more days when the new data comes out and you're going to see people, I think you're going to see those numbers shoot way, way up.
Yeah. And then, so guess what? There will be other casualties because the servicers, they still have to make the payments to the investors. So when the government said, okay, yeah, forbearance, you don't need to pay for 3 months, 6 months, a year, whatever it is. But then they didn't think it through. So right now, the non-GSE banks or mortgage servicers, they still have to pay that, okay? So again, we're going to see a delay unless this all plays out again, right? We won't really know if people will lose their homes or have a problem because we won't see it this year, okay? Because this all has to play out, okay? And I'm trying to get did I say forbearance? Oh, so if you are in a forbearance, and hopefully Mike will maybe speak about, be careful with the fine print, okay? So today, or everybody was told that they can't request to do a lump sum payment because if you have to come up with 3 months payments on month 4, I mean, that's not going to help you. So the ideal is really to add the payments at the end of, that's probably the ideal way to add the payments at the end of the loan. Okay.
I just saw that today, as a matter of fact. What they're saying is that they're going to require a loan modification to be done. They're not just going to tack it on. They're going to have to do a full-blown loan mod.
Oh, God, because there also could be like, you could just add it to the balance and then recalculate the payments, right? So I have another great poll, but I'm not sure what the poll is going to be. Oh, actually, that's going to be an interesting part. So are you going back to a large group of 75 and plus people to live meetings? So if everything is good, or are you only going to live meetings, group of less than 10? And Mike, you can get ready if you hear me. You gotta wake up Mike.
I'm here.
Okay.
I'm awake.
Did you hear all the unqualified things I said about, I tried to make sense of it because it is just, to me, it is highly interesting.
Yeah.
The government, I know they try to speed things up and I appreciate it, but don't they have people on staff that can actually think it through? So it's a little bit more effective. All right, so we have 12 voted. Okay, we'll take end polling. We share results. So you probably noticed too, just like I don't know, this week I have 6 webinars or Zoom calls scheduled. And I actually like it a lot. The only thing I'm missing, like I'm talking to you, I can't read facial, expressions, and but if you guys unmute yourself and have a question right now. So you guys see the results? So pretty much half of it would go back and, no. The most of us would go back, but prefer a smaller group setting. Okay. So, because I want to gauge, because we have a lot of the investor clubs meet, right? And we have large meetings, and even up in LA, they have meetings. I mean, it's definitely 75 people and plus. Or do we enjoy not driving anywhere and can have a cold one where we're sitting and listening, okay? All right, so now we have Mike with Loan Depot and Meredith, who have a wealth of knowledge, and you heard all these questions I threw out. I hope you heard it, Mike. All the questions I had, particular is, you know, forbearance, interest rates. How do you adjust to your new normal? And are you working from home, adapting to technology, and some background on maybe what's going on with the GSE, and what do you do if you don't have a GSE loan?
Yeah. No, those are all really good questions, and I actually appreciate, you know, all the points you touched on already, Lenska. I'll try to kind of just compliment, I think, you know, kind of the direction that you're taking the conversation. I appreciate what Bruce was sharing too. There's just there is a lot of tightening in the credit markets and the mortgage market. So I think just in terms of looking at the overall headwinds, it's odd that we're just getting gorged on too much business, and then that's causing a lot of problems in the secondary markets. I mean, I've used this reference a couple different times. Is that year over year the volume for our company is up over 4 times. That means that literally last year we did about 65,000 loans for the year, and last month we did 20,000 loans. And then if you multiply that over the industry, you know, just the capacity in terms of people to get loans closed, and then credit line, you know, capacity and facilities, it just is really challenging. And I think the Federal Reserve Board and Congress and, you know, the president are all trying to learn lessons from the financial crisis in this way, and in responding more quickly. And I think you're right, Lenska. I don't know that it always makes sense. And some of the things that they've done had unintended consequences. As an example, when the Federal Reserve Board came in and started buying, you know, basically blank check, putting mortgage-backed securities on the balance sheet, it blew through a lot of the hedges that the mortgage banking industry had, and that caused massive temporary problems in pricing and interest rates. So lots of interesting things, and again, overall, you know, the mortgage industry, you know, by all indications, is just getting stretched in every which way. The early payment default and the whole conversation about the forbearances, I do think it's fascinating, and just maybe to touch on that now and maybe finish on it is the initial I guess comments were that anybody that was having a problem with a loan could immediately get, you know, basically payment forgiveness or a forbearance, and that was by a verbal request. Didn't even have to, you know, verify that you had any hardship or that you needed it. You just said, hey, I'm affected, and so I don't want to make my payment, or I can't make my payment. And that just terrified, I think, the mortgage industry and the big banks, just for a whole bunch of different reasons, just loss of cash flow from payments not being made. But then also just the implications on not being able to sell a loan, that when a loan is in forbearance, you know, even if it's, you know, under the auspices of a government relief package right now, it's still, you know, identified as a pre, you know, foreclosure or a payment default. You know, it's essentially a troubled asset. And so even though, you know, the Federal Reserve Board, you know, is buying what I think 40 billion, you know, worth of mortgage-backed securities, I forget on what interval, but they're just blank checking that. They haven't really been clear back to the mortgage banking industry on covering, you know, payment shortages, and then when loans are sold to the secondary market. I mean, you know, reps and warrants, really, if you have early payment defaults in the first 4 months, that loan's not sellable. And so then therein lies the problem, because the mortgage markets, primary mortgage markets, it's just about doing that original loan and then selling it. But if you can't sell it, then you got an issue because you're going to run out of money. And so, so all that kind of stuff, to your point, I think is being figured out, and it's causing abnormality and pricing and volatility, and certainly again a tightening of credit in a couple of different ways, So on the payment default, interesting that the GSEs, Fannie and Freddie, came out and said, hey, we'll buy your loans even if, imagine somebody's going into buy right now and they're furloughed and they're not making any money and they're going to finish transaction and they're not going to make their first payment. And then Fannie and Freddie said, well, okay, well, we're going to still buy, or they just bought a home and they're hitting that early payment default category. It makes that loan technically unsellable. Well, Fannie and Freddie said, okay, well, we'll buy it. Don't worry about it. But we're just going to add a premium, loan level price adjustments, adverse market adjustments, risk factors. It was like a 300 to 500 basis point estimation on what they were going to add to the cost of buying that loan, which basically means that lenders have to basically, pay for, the gift of closing a loan. And so it's just, it caused it's causing just the entire industry to work through all these issues. So, conventional bond loans, 100% financing, low credit score loans, high debt to income ratio loans, all that's kind of being pulled back, again, in the light that there's still just an over demand of folks that want to save money on refinancing, lowering their interest rates, consolidating their debt, and there's enough premium business out there not to do, the higher risk loans on the, on the edges of all this. And keep in mind, this is really fascinating back to the financial crisis too. FHA and VA, they guarantee and insure up to certain percentages, right? VA is 25%, right? Mortgage insurance, when there's not 20% down, and 20% down is basically insurance, but FHA, covers a lot of risk for lenders too. But the last adjustments to market values blew through all those backstops. And so again, if you're doing somebody that's putting, 100% financing right now, you're looking at, 20% unemployment, somebody that might not make payment, and you're looking at a 10, 20% possible drop in market values, then you go, I'm a little concerned about my risk. And then I'm not going to get a payment. And so that's what's causing just a lot of interesting things. Now, out of all that, and I think you're right, the unemployment is a massive challenge. I was interested a ways back, listening to some factoids on mortgages and interest rates that, like a 1% improvement in an interest rate probably offsets a 3% increase in unemployment in terms of who qualifies and not. But now, again, the magnitude of what we're looking at least temporarily, is a lot greater than that. But
well, here's a question,
really
Mike.
What's that?
Here's a question on that.
Yeah.
Our last round of this, when we were going through 07, 08, 09, there were no programs out there. Now we have programs like California, stay in your home.
Yep.
Do you foresee more programs like that coming about for people to stay in their home even if they can't make their mortgage payment?
Yep. 100%. And Leo, I think it's such a great point. I think inventory, home ownership support from lenders at all levels, some government response and relief, all that I think will, kind of mitigate, foreclosure and default rates. And you both know this better than me. I'm pretty sure that the inventory back in 07 and 08 was, closer to 17,000, not 4.
Man, we had thousands upon thousands of properties, but we didn't have programs.
Yeah.
So most, like California, didn't have, like what they have now, stay in your home program.
Yep.
So from that standpoint, it took years. In fact, people lived in their homes for 3, 4, 5 years without making a mortgage payment before they left that home. Yeah,
you're right. And the banks, and this, the banks were so backed up, in their real estate owned divisions, they couldn't process all the foreclosures. And so people kind of were squatting, in their homes for a long time. But now, and to that point too, the initial, I guess, indications about forbearance plans, they're going to run, likely, already they've been suggested at least 12 months. And there is a difference between a forbearance and a deferment and a modification. Unless you're completely right. A forbearance is just a temporary restructuring of your payments, and so there are some responsibilities, let's say after 2 months or 3 months or 4 months, that you true up on those payments in a short period of time, which might not be feasible. And that's much different than some initial lenders were announcing deferment plans where you could just add those payments to the end of the loan. But but a modification is a complete. It is basically a renegotiation of your mortgage contract, and most of them do that. From my experiences from working on this 10, 11 years ago, is they take the payments that were lost plus any interest that was accruing, and they put it in a non-interest bearing account, as a balance on the back side, and then they structure the payments around what's left, so again, it's a home affordable plan that was part of the Obama Affordable Plan program, where you negotiated affordable payments for people where they were at.
Yeah, but the majority of them couldn't afford it then. They couldn't afford it 2 years, 3 years later.
Correct, like less than 5%, I think. I mean, you're right. It was. And by the way, and Leo, I think you can add, and Lenska, you can add color to this too. Unemployment is certainly a driver on foreclosures.
Yep, absolutely.
However, what the financial crisis really showed too is that when people walk away is when they have no equity, when they don't feel like there's any investment in their investment, is when they quit. And that's kind of a multiplier. That's an accelerant. It's like pouring gas on a fire.
Yeah, but remember, we're only looking at maybe the last 2 years, that when people bought. Everybody else obviously has a lot of equity because prices, practically went up nearly 100% the last 10 years. So
exactly, and that's exactly the point.
You have, and I mean, in the last couple of people that really bought probably also had pretty good jobs. So the whole underlying loan balance, borrower, and everybody is a little bit different, but they're stretched on other sides.
But the majority of mortgages back 3 years ago were in sectors that are being affected by this virus today.
I mean, there is not a sector that is not affected. I mean, even the tech industry is a little bit affected, right? Because even Eventbrite and look at what happened with WeWork, and it's a complete reset. Mike, is this how you really feel?
No. I maybe I'm not expressing. Oh, that's how I feel. Absolutely.
There you go.
That's actually me.
No.
That's me in the last 5 weeks. But your point is great. That's what the silver lining is right now, is that we're from a home ownership, from an equity standpoint, this is entirely different than the mortgage meltdown.
Right.
There's more equity out there for homeowners than there was before, and there's certainly less inventory, and there was less building. And so my only point, my encouragement, that's, at least my opinion, and that's going to mitigate, I think, what could be maybe more drastic. And it's right now, the mortgage industry will work itself out. Jay Powell has been very good at connecting with industry experts and trying to listen to what's going on and understanding, and trying to make mid-flight corrections. And they are trying to speed the market, support, so this doesn't become, worse than it is.
But the big thing right now is, even though they got the equity, HELOC loans have gone down drastically.
Mike, are you still doing HELOC loans?
Yeah. I mean, we are. There's this. Yes, we are. But we've tightened up. I mean, from everything from renovation to loan to values has certainly, backed up a bit. We still actually have some HELOCs to 90. I mean, which is pretty fantastic. Jumbo is extremely hard to come by. All the banks did pucker up.
So what is the loan limit now, or when does it become jumbo?
Yeah, in San Diego County, it's high balances go to 7015, and that's a really good point. Conforming is 510,400, and then high balances 7015 becomes jumbo after 7015. Up in Northern California and Los Angeles, some pockets are 765. And above that, you're looking at larger down payment requirements or dramatically higher interest rates, and reserve requirements, debt to income ratios. You just have to be, extremely solid in that jumbo space right now. So high balance up to 7015 is what we're seeing the most of. Conventional, conforming, FHA, VA, your best pricing is on conventional loans. We still are getting into the 3% range, on a 30-year fixed rate. We were locking in 15-year fixed rates at 2.625%. And a few at par, depending on the loan to value and the FICO scores and the loan level price adjustments. There is really good news in that. High balance is kind of tricky because the way that high balance loans were being sold, you can only sell a certain percentage of high balance loans with your conforming loans to the agencies. And then private investors were buying, other portions of that, and they were mixing in their jumbo business. And when the market shut down, and it really was because of cash flow and liquidity issues, and nobody knew what was going to be sellable on a jumbo loan. So high balance pricing kind of started to separate pricing, and there's volatility. The good news is, I will say this, the really good news is
there, I think don't I have a slide? More good news?
Well, only you would know if you have a slide.
Super good news.
Is this good news?
Yes. Well, you know what? The interest rates are good news. Our turn times on purchase business is good news. We really are. And because of this, the technology, our online applications, we're digitally verifying most of the time assets and income. Even credit and title have been, digitized. We're getting a lot of property inspection waivers, on loans that we hadn't seen it before. Powers of attorney, limited powers of attorney are being used to help the process. Remote online notarizations, become quite popular. We actually went, within this 2 months period, we went from 20% of our loans, being basically electronic digitized files to 80%, like in 2 months, and wow. So the e-docs and the e-signings, it really is a transformation. And so people can do loans safely. They can do them conveniently. There's a lot that's, this is kind of fast tracking, things that we weren't able to do before. And there are savings out there, there really are savings opportunities. Just the key is to just, be prepared, get ready, get in line. If you're gonna buy.
Yeah. So if I have a good job now and I'm listening to this information, so what do you recommend for somebody that has a good job and still thinks, he gotta get out of the 2-bedroom apartment with his 4 kids and his wife, and he's going to work from home, so they're looking for a bigger home. And what do you recommend?
Yeah, I recommend you get pre-approved and stay pre-approved so that you can move quickly, and jump on opportunities as they come up with what you want. And by the way, even for refinances, what I also recommend, if people own other properties, it's better to borrow, when you want to, not when you have to. Yeah. Better to borrow when it's cheap like this. And it's better, if you're going to separate equity right now and look for an investment opportunity, because I think both better than me, there's going to be a lot of opportunities.
Yeah.
Now's the right time to pull cash out if you're going to pull cash out. We see a lot of people.
Mike, can they do a HELOC loan along with refinancing?
Yeah, we have to stagger it. We can do a cash out to 80 on a primary, and then we can piggyback. It's not after the close, a HELOC. So, it's interesting too, Leo. We've ran into a lot of scenarios where we're trying to pay off HELOCs that were put on not for purchase, and then they trigger cash out.
Okay,
Guidelines.
speaking of cash out,
Yes.
so you still do cash outs?
Yeah, and actually all those payments were factored at 3.5, and at 3%, you're taking probably another 6% off that payment on the 300,000. You're saving almost about $90 a month, which is good.
Yeah.
Well, there's no
if
house here at $300,000 range, so.
Well, you know what, we're seeing a lot of folks. We are seeing a lot of folks that are just trying to get ready for opportunities. They're pulling the cash out now if they can.
Yeah.
They are. And by the way, the renovation lending conversation, as Meredith is so good at talking about, is alive and well. There are opportunities to lever higher than 80% if you're in your primary residence and you want to build an accessory dwelling unit. Still can go on a conventional loan up to 95% of projected value. That's a big deal for people that want to try to monetize, their primary residence with some rental income off an accessory dwelling unit.
But you just heard Bruce say about the cities and getting a permit, and that all takes a little bit longer. But so you're still doing cash outs, you're still doing ADU financing?
We are. The things that we're not is bond loans, 100% conventional. We backed off of that. Jumbo's very, very hard to come by, or very expensive right now. But
So
we are doing
if
renovation
you're an
lending.
investor listening in right now and you have $1 million plus fixer that you're bringing to the market, then they will have trouble unless that person puts 50% down to get financing for the buyer.
You're right. And you're right, Lenska. For a traditional mortgage lender right now, they're going to be in the conforming, the high balance space. You're not going to go above 7.015 on a renovation loan on an accessory dwelling unit right now. The jumbo renovation is on hold right now. Is on pause.
So in California, your loans are declining then.
Say that again, Leo.
In California, your loans are declining.
How do you, our loans are declining. How do you mean?
In California, if you're
your
not
volume?
Yeah, your volume of loans. Yes.
Yes.
Yeah.
Saying that earlier.
Yeah. So year over year, we're dramatically up. Week over week, mortgage bankers showed refinances down slightly and purchases slightly up. So there's a lot of different experiences out there in mortgage banks, depending on the mortgage company. Best I can tell from talking to a lot of folks in the industry, some companies are doing a lot more business, and other companies are really, really struggling, with their capital markets, so it really depends on who you are. But according to mortgage bankers, I think it was 9% week over week that refinances were down, but again, purchases were slightly up.
Right. Okay.
Okay. So is this for San Diego? So your mortgage applications were up, you're saying, in San Diego?
No, they were up. They were on company-wide 4%, our purchase business and the refinance business. And this is week over week. Every week now, with everything changing so quickly, and it's true, there's so many guideline changes, so many policy changes, because it's such a dynamic environment out there. We have weekly leadership calls, and week over week, refinance business was down from the week before to last week, 9%. Purchase business was up. That was company wide. That was on the retail lending basis.
Okay. All right. So then, and is this, so do you get the phone calls for the forbearance, or can you tell people where they should start? Obviously calling their lender, right?
Yeah, calling their lender, and we have a homeownership support center, with customer service that's helping the loans that we're servicing, and certainly even the ones that we've sold. They'll make sure to get connected. It is so important, like before, to make sure that people talk to their lender about their situation, not listen to generalities, or make assumptions. And certainly make sure that you have, details in terms of writing. And it varies whether you're with the money centers or your loan was sold and who it was sold to and where your servicing is at. The ultimate investor really drives, what the repayment strategy and plan and options are on that mortgage.
So, okay, thank you so much, Mike, for sharing giving us the background, the insights, the good news of the real low interest rates. And I feel too, we're getting ready for opportunities. So everybody get their financial house in order. Look at each asset, if you can cash out now or refinance at the lower to free up some money to maybe buy another investment opportunity, a house next year. Or if you don't own your own house, there's still some good deals. And as we mentioned, to add another unit in your backyard, or if the property or the house is big enough, you can actually do an junior ADU inside the four walls of that particular house in order to help also pay for the mortgage. And suddenly you can still live in a house and not an apartment. And I tell you, this whole virus thing is probably far from over. And don't you rather want to be stuck in a house than stuck in an apartment? So I am praying every day that I live in a very nice house. I actually opened the swimming season yesterday. It's pool time. So, and it's not too bad to work from home and be stuck from home, but.
Yeah, we saw that.
Hey, Lenska, though, I got to add just one thing, if that's okay, on the forbearance.
Oh, yeah.
It just so that people really want to make sure that if you can't make your payments, get help. But don't take it because somebody said you could if you don't need to, because your repayment record, that forbearance, is going to affect your ability to borrow into the future. Your mortgage payment history is going to be affected, at least right now.
It's not supposed to.
Yeah,
But no, it's not supposed to impact your credit rating or your credit score or how you go forward doing anything really with a loan.
Right now, there's a big challenge with the agencies not changing their guidelines yet. So, there's still a mortgage payment history that is considered applicable going forward. If they change their guidelines going forward, then we'll be okay. The issue, and I think that the concern is that some people are being quite aggressive on whether or not they can take advantage of non-payment because of the situation right now. And I'm just concerned that some people might be making a bit of a mistake on their repayment history. It's not to say not to use it if you don't need it. I just know mortgage payment histories are a part of qualifying, and it's going to be an issue, I think, going forward.
Well, then here's the question, Mike. Would you prefer to see someone filing for a forbearance or a deferred, or would you prefer to see somebody filing a HELOC loan in order to help make their payments?
Yeah, I mean, if you can get a HELOC, that's a good point. I mean, it's better to have the liquidity and do that. And I'm not saying all the language is out there that there's going to be some forgiveness, and I'm sure we're going to come out with, adverse market guides, and waiting periods specific to the COVID period. It's just not out there yet, but yeah, a modification, there's no waiting period on a modification. Yep. I just know right now, if you have more than one time 30-day late in the 12-month period, that you're not ready to go on your next loan right now. That's it. And somebody that's in a forbearance plan isn't going to be able to go out and make an investment with a traditional loan right now. Nope. That's it.
Yeah.
So use it if you have to, but to your point, yeah, if you have other levers that you might be able to take advantage of, certainly do it. And I don't mean that, with any callousness towards folks that need help. I'm just making the observation that I'm concerned that some people might be taking advantage of relief that might cause them problems in the future.
Right.
Yeah, so I want to give Jeremy a wake-up call and quick. If you are sitting on a house right now, free and clear, so to speak, so you have the option of doing a cash out refi, right? Or Jeremy, give us another tool in our toolbox.
So yeah, with the HECM loan, the HECM is a home equity conversion mortgage, and specifically it's for seniors 62 and older. And so there's a couple common misconceptions that I just want to clear up right off the bat. One, people think you either have to have your house paid off entirely, and that's not true. We can actually use these HECM loans to pay off existing loan balances, and then we fund the rest of the loan on a line of credit. And what it is, it's an FHA insured line of credit. There's a couple of really big differences between these HECM lines of credit and traditional lines of credit. These HECM loans, once they're set up and in place, these lines of credit can never be reduced or they can never be revoked, just as long as people meet their loan obligations. Their loan obligations are pretty simple to meet. One, it has to be their primary residence, so they can't do these loans on investment properties. However, they can do these loans on their primary residence, and they can use the money to build things like ADUs on their rental properties or to purchase rental properties. One of the things that we're teaching people how to use these for is to actually use these loans to put ADUs on rental properties. You can use these things to pay for upgrades. AARP did a study not long ago that they found 76% of people surveyed want to age in place. And so people need a way to actually stay put. Traditional financing calls for a monthly payment. These loans, you're never required to make a monthly payment. If you're using them to build an ADU, you don't have to make a payment before, during, or after construction, which means all the money you bring in from your rental is cash flow. You can also use these things to pay for things like unexpected medical expenses, which are huge when you're 62 and over. So I'm actually launching a webinar series in May. I partnered up with Crest Backyard Homes, and we are going to be teaching people how to use these HECM loans to build a manufactured ADU on their property. So make sure you tune into that later.
Okay, but I want to know the details. So what would be now, has anything changed for you in the last few weeks? Are the HECM loans now the loan to value? Is this limited, and what are the interest rates?
No, so the loan to values haven't changed with us. So these are FHA insured loans, and all the parameters are set in place by HUD. So they don't change with the way like traditional lending works. Interest rates are determined by the product. There's a couple different products. You can do fixed or adjustable products. Some people aren't comfortable with adjustable stuff. The fixed products limit you. When you fund a loan like that, it's set up as a lump sum payment rather than as a line of credit. So there's also some loan to value restrictions on those. But for long-term solutions, what I found the most effective way to do it is to do the annual adjustable and to do the line of credit option, because it gives you the most flexibility. One of the biggest benefits of the HECM line of credit is that the unused portion actually grows over time. So someone may not need all the money right away, or not have a use for all the money right away. But the earlier you set up those lines of credit, the bigger they grow in the future.
Okay. And what's give me an interest rate range?
So the fixed stuff can be anywhere from 3.99 to 5.16.
Okay.
And
that is great, because and especially good for people obviously they don't have any other income or don't work, right?
Yeah, so these loans are not income driven, which makes them exceptional for investors, because a lot of times investors, if you have multiple homes financed, you run into cash flow issues where you only get to use, like, for instance, 75% of your rental income. These loans are specifically done on primary residences, and the value that we use is the value of the current primary residence. So it doesn't require any kind of debt ratio. It runs on what's called a residual income instead.
Yeah.
Do you have to be a certain age to qualify?
I'm sorry, say that again?
Do you have to be a certain age to qualify?
Yes, 62 is the minimum age, but there's no maximum age. In fact, the oldest, my client, the oldest one I've done she was 100 years old.
Now, anyways, I heard the 35 is the new 62. So we all live longer, and definitely this is one of the housing challenges, the demographics, because we do want to age in place, that's for sure. Mm-hmm. And it looks like some of us will maybe get our college kids back, and actually the college kids are already back. So there's a huge amount of college kids that actually went back home to kind of live with their parents while this whole stay-at-home order is going on. So certainly, all right. So actually, we got it all covered, from hard money that is not reliant really on your credit score and your and Bruce, if you are still on the phone call, I have a question for you from John. Are you doing any commercial lending?
No, not right now. I answered John in the chat, but
Okay.
for the rest of the group, no, we're not.
Okay. And so I think I have one last poll I want to, and then we can open it for oh, did I share the results? And one last poll before we open it for questions. So if you guys have any questions, anything you want to add to it, that would be great. So I think I have, so my last question to you guys is, have you had any problems closing your deals to front end, like the hard money deal, or, you know, buying a home and had problems, and at the back end you sold something and you sold some, or wanted to sell something and it fell out of escrow, or you didn't get the financing?
Honestly, so from Mike and I's perspective, no. It was a little slow. We were getting, you know, for refis, we were doing 45 days. A lot of investors doing property refis to add ADUs, and that was going 45 days. Wells Fargo was reporting 4 to 6 months. But we're waiving so many appraisals right now that we're kind of down to that eliminates like 10 days. Sorry, I have the hiccups. But yeah, so we've actually been doing okay when you fit the guidelines.
Okay, so yeah, so people didn't see, and we had only half replies, so that was kind of, I heard other things, that about 30% of the escrows that fall out has to do with financing issues. Yeah. So, and so we can kind of open it up for questions. And if anybody has anything, I think everybody is still on. Bruce is on. And I always can't stress enough, our health is the most important thing we have. So put that first in your daily routine before you go and eat healthy, and then study up. It would be interesting. I should have had another poll on how many people listen to webinars and everything else. And so study, get a new skill sets. I think we all can change our business plans. I mean, look at me. I'm trying to assist people and put some information and education on Zoom. And pretty soon we can connect again, maybe through live meetups and real estate clubs. And as I always say, I have a market update on YouTube. I also serve on the board of SDCIA, the largest club, and we have great content and webinars, and our live meetings actually bring in a lot of people. And we have in May, we have a very good lead generating webinar. And then in June, we have Robert Campbell, who's known to be, he wrote a book on market timing. So he has his own, and if you would have subscribed to his newsletter, you would have known, coronavirus or no coronavirus, that we were on the verge of tipping over the the high point of real estate prices. So do we have any questions from anybody?
I have a question for Bruce.
Go ahead.
Bruce, is a cost of lending gone up?
Yeah, a little bit. Probably consider, you know, loans from everybody now are going to revert back to what they were, you know, 2-3 years ago, 10, 11%, you know, 2-3 points. So I haven't done a loan here in San Diego in the last 6-7 weeks. But
And that's what we were talking about. Lenska and I were talking about. The majority of your loans are up in LA, right?
no, well, company wide, we just haven't been doing many loans. So I would say that 30% of the business that we do comes from San Diego.
So out of San Diego, 70% of your business is out of San Diego.
No, 30.
Or no, that's 30% is in San Diego.
Yeah, 30% in San Diego.
70% out of San Diego.
Oh, 70.
That's saying
Yeah, but-
something because 20% of the hard money lenders are completely out of business. So kudos to you, Bruce. I knew you were good.
Yeah, no, Leo, we got more areas because we do Orange County, LA County, and we have a VP up in the Bay Area as well. So, yeah, we've got a wide market.
So what do you foresee with San Diego, both either you or Meredith and Mike, in growing the loan count?
You mean like, are we going to be doing more loans in the coming years?
Are you pursuing San Diego market or are you pursuing LA market?
Well, I would say we're pursuing each market evenly or equally because we have a person in each market.
Okay.
Okay.
I gotta tell you, I smell fear in the water, and my traditional purchases, the sellers are freaking out.
Yeah.
This is a great time to ask for a deal, ask for seller credits. Seller credits are super popular to help cover cash to close, but yeah, sellers are freaking out.
Meredith, you know where there's a house across the street from me that's been on the market for 45 days, and I was going to go ask for owner financing on a $600,000 house.
Oh yeah, absolutely.
Yeah, so we'll see.
Totally.
And
with $1,000 a month payment.
A very low balance.
yes.
Yeah.
All right. Anybody else has a question?
This mine's more of a comment. It's to your all the college kids moving back home with mom and dad. I've talked to a bunch of financial planners and financial advisors, and there's a general consensus that the number one reason that people don't have enough money set up for retirement is because they have been funding adult children. And so I just want to make people aware of that and just caution against it a little bit, because it's the number one detriment to not being in the place you want to be when you're retired.
Yes.
So
Yes.
rekey your houses.
Just move and don't tell them.
Yeah.
Get a PO box. Tell them you're doing Zoom meetings from now on.
Yeah. Okay. So that is perfect. That is a good close, unless anybody has a question. And I know we ran over again. I know I always get very ambitious of trying to get different perspectives all in one phone call. But I think it gave us a good cross-reference what everybody is feeling. And yes, we try to stay optimistic, but we have to look the enemy in the eye. Okay. So
I have one question.
Shoot.
What was Meredith tipping back?
Oh,
What
was
were you
she
drinking, Meredith?
Is that
Wow.
And I want you to know, excuse me, I'm having hiccups, it's terrible. But we just planted our vineyard, and we're going to have a blessing of the vines. So
There you go.
Nice.
let's all cheer to good times and good money. And I appreciate everybody listening in and presenting and sharing your wisdom with us. Thank you so much.
darn well bet that I'll be sharing my next little nip of brandy.
There you go, John.
Thanks, guys. Looking forward to it.
Thank you.
Thank you, Lenska. You're the best.
All right, you too.
Sounds good, Leo.
Thank
Good night,
you.
all.
Thanks, Bruce.
Thanks, everyone.